Testing. Alright, good morning everyone. Welcome to Phillip Securities Research Weekly Market Outlook. I'm Wei-Wen. I'll take you through the market outlook. And also in the agenda today would be one of our featured company, which is Genworth, which is a US company, and Yongkai will take you through that particular featured company. Alright, in terms of market direction this week and the weeks ahead, last Friday we saw better than expected jobs data, right? And although jobs data came in better than expected, it was not exactly fantastic, right? So nonetheless, the S&P still bounced above its 50-day moving average support level. But our base case is that the Fed should begin signaling its tapering of large-scale asset purchases come September, once it has a full third quarter of jobs data, and will only begin actual tapering in December. So that's our base case, right? And also come September, we think that it would be a blockbuster month, largely because we would also have the debt ceiling deadline again, right? And we could once again possibly see some political gridlock. Now, in China, the thing is that there are concerns over weaker than expected growth in China, right? Coupled with an end to the commodity super cycle. Looking ahead, we think that the Chinese government is actually caught in a dilemma, largely because should it want to ease on monetary terms in a bid to stimulate growth, that would send a wrong policy message, largely because property prices, especially in Tier 1 cities, still continue to rise. Nonetheless, it's important to note that the Chinese government has actually expressed greater tolerance for slower growth in a bid to restructure the economy towards more domestic-driven consumption growth. Now, in Japan, we see that we caught some signs of supply-side structural reforms, right? When Abe launched his third arrow, or gave some signs of his third arrow last week, but at this juncture, there's still no signs of an overhaul of corporate tax, which, if materialized, would be warmly welcomed by markets. And we think that looking ahead, we would not see much details of these supply-side structural reforms until the July upper house elections are over, right? So in terms of the Nikkei right now, we think that there's still downward bias, right, amid a corrective wave down. Major risk event this week would be the Bank of Japan meeting, actually tomorrow, right? For the S&P 500, it actually bounced up above its 50-day moving average support level on better than expected jobs data, right? But we think that the 50-day moving average will still be retested in the coming sessions. The HSCI actually broke below its 50 and 200-day moving average support level, and the bias is downwards. HSI similarly is also in a downward bias, testing key support at 21.5K level, and has already pierced through its 50 and 200-day moving average. So essentially in Greater China, the indices confronted with downward bias. For STI, it fell through the psychological 3,200 support level, and we think that the tone would still be bearish for the STI. The Thai index, right, it also pierced through the 1,005 support level after a 25 basis point rate cut on end May. For the Jakarta Composite Index, which was the most resilient until last week, it actually broke below the 5,000 level. Risk event ahead will actually be the Indonesian Parliament's ruling on a scale back in fuel subsidies, which should come mid-June, right? So that will be the main risk event for the Jakarta Composite Index. And for the KLCI, it's mainly consolidating gains, right? Although momentum has sort of eased. With that, I'll pass on to Yongkai, who will take you through Genworth Financial.
Hi, good morning. I'm Yong Kai. I will be covering this US insurer, General Financial. Okay, so the share price as of last Friday was 10.92, up 3% from the release of my reports. 52-week range is actually $4 to $11. So it's climbed quite a bit in the last 52 weeks. Market cap now adjusted is $5.4 billion, which actually makes it in the index component of S&P 500. So just some quick background. It was formerly owned by General Electric. Partial IPO in 2004 to raise capital for this parent company. The GE actually monetized its interest at prices between 1950 to 34.66. At the point, they actually had 490 million outstanding shares. Today, the share price is $10.92 and outstanding shares is 497 million. So just some quick operating segments. Okay, I'll quickly move into investment merits. As you can see, there's 5 key operating segments. There's quite a few of catalysts right here. Firstly, what we see is that market cap is $5.4 billion versus the book value of $16.2 billion. So this actually makes it a deep value play. US mortgage insurance is a proxy for housing recovery in the US. Competitors are actually trading at 2.3 to 2.6 times book value, and on some certain metrics actually performing worse than Genworth. International Mortgage Insurance, they really IPO'd the Canada subsidiary in 2009. Right now, they have plans for IPO for the Australian MI in 4th quarter this year, pending a pickup in IPO activity. International Protection, the key exposures in Europe, but they are still profitable and is positioned for sale in the next 2 to 3 years. US life insurance actually is a very big component of Genworth. Its book value is $11 billion, which makes it more than double the market cap. The long-term care players has already exited, so Genworth currently is the biggest player with 24% market share. They're actually appealing for a premium increase, which will rake in $200 to $300 million additional revenue. Lastly is corporate runoff, where the debt is consolidated at the holding company. So I wouldn't take too much. I won't be too concerned about the negative book value. Management is very proactive. So rather than no talk, no action or talk, what they've done is actually they have sold out a lot of non-core assets over the years. So you can see that they have actually, of the transaction value, they actually accumulated about $3 billion worth of non-core assets and after-tax capital benefits since 2007. The first operating segment that I'll be talking about is US mortgage insurance. So the industry primer, what we see is that the US lenders traditionally require a down payment of at least 20%. This to buffer against borrower defaults as well as falling property prices. If the borrower wants to borrow more than 80% of the property value, they will require a mortgage insurance. This insurance will cover 25% of the loan. So let's say if borrower loans $200,000, the insurer will be liable for $50,000. This is otherwise known as risk in force. In the 08-09 financial crisis, quite a few of the players collapsed. So what's left is actually left with AIG, Radian, MGIC, and Genworth. In the event of a default, the insurer has quite a few options. It can either pay up to its maximum coverage. Number 2, it can acquire title to the property, and subsequently they can decide whether to hold it for rental income or sell it at a better price. Third, they can mitigate losses through policy rescissions, repayment plans, etc. This is actually a very important option to them. They actually save more than $2 billion since 2008 just by mitigating losses. At one point or another, all mortgage insurers were close to breaching or breach the regulatory requirement of 25:1 risk to capital ratio. But after fundraising as well as financial maneuvers, all the remaining players are compliant as of now. One good thing is that the losses from older policies are running off, whereas the newer policies after 2008 generate highly profitable 20+% ROE. For Genworth, these newer policies make up about 1/3 of the in-force mortgage insurance policies. Some interesting recent events. As of 28 February 2013, MGIC actually announced a quarterly net loss of $380 million. Annual net loss was actually $1 billion. This leaves it with actually shareholders' equity of less than 200 million versus assets of $5.5 billion. Amazingly, after the company announced plans to sell shares and debt, investor demand immediately pushed shares up 27% to 380 for the day. By the time MGIC announced a fully underwritten $1.1 billion raise, share price has already closed at $5.60. 185 million new shares were offered, compared to just 200 million shares outstanding at the moment. In all, MGIC sold $500 million of bonds and $600 million of shares at $5.15 per share versus its then book value of 97 cents per share. So do a quick peer comparison. Genworth actually has the second lowest delinquency ratio. Even though it's writing less, it only has a 12% market share of its new insurance return, but its risk in force is actually pretty high. And we will also explain why certain competitors have higher new insurance return compared to Genworth. So things to take note is that AIG and Genworth have turned profitable as of this quarter, first quarter 2013. If Genworth USMI were publicly traded, similar to its peers, and we use the EV over RF as a metric, this segment could be valued at $2.14 billion or $4.31 per share of Genworth. Yet, if we had used price vol book, then we are looking at higher valuations of $497 to $562. So again, bear in mind, Genworth, although its new insurance return is only $4.7 billion compared to Radian, which appears to be writing the highest of $10.9 billion. But Radian is actually underpricing its policies. So for insurance, it needs to be priced appropriately. It's not just a volume game, but it's a profitability on the individual policy basis. Effects from bad pricing wouldn't be seen for years. 36% of Radian's policies are single premium. The bulk of Radian's policies actually has a good credit score of 740 and 85 to 95% LTV. Let's compare with the industry pricing, which is identical 1.63% for 85 to 90% LTV and 2.04% for 90 to 95% LTV. Yet Radian's pricing is 1.37 and 1.65% respectively. Interestingly, all other policies, the quotes match the industry. So we think that they're actually intentionally underpricing its policies and is out there cash grab for a single premium just to stay afloat. Moving on, we'll talk about international mortgage insurance. Some key differences from USMI. The policies require upfront lump sum payments, which is gradually recognized over the years, in contrast to USMI, which is mostly monthly recurring basis. Meanwhile, the unearned premiums are invested and recognized 100% coverage. They are liable to 100% of the loan. On the other hand, the payout will be reduced by the net proceeds from the sale of property. Hence, the effective risk is computed to be 35% based on this as well as historical loss experience. What this means is that if the borrower takes out a $200,000 loan, the net loss, maximum net loss liable by the insurer is calculated to be around $70,000. Both are profitable and generate excess capital. In fact, in the last 3 years, they have paid out $966 million dividends to the holding company. Canadian MI was actually partially spun off in July 2009, whereas Australia has plans for fourth quarter or after. Okay, background about the Canada MI. They entered the market in 1995. Currently, they're the number 2 market share, with number 1 being the government owns CHMC. There's only 3 players, and the number 3 is very small. As of 2009, it only has $120 million Canadian dollars of shareholders' equity. Competition has spurred premiums to fall 30% since 2003, and the presence of number 2 and 3 actually provides alternative options for borrowers and reduces risk to taxpayers. In fact, Genworth MI Canada has $3 billion Canadian dollars equity. What I'm trying to bring across is that there is value for the number 2 and 3 to be in the market to compete with the government-owned entity. Right now, Genworth Canada MI insures 150 billion Canadian dollars of outstanding mortgages out of a maximum limit of 300 billion Canadian dollars on private insurers. For the CHMC, their max is 600 billion dollars, which they are fast approaching. They've actually reached 560 billion dollars as of first quarter. So quick look into the financials. The net operating income is consistently above $300 million. Loss ratio has stabilized below 40% for past 3 years. Delinquency rate is actually a very low, 0.14%. Notably, the book value per share has increased 40% in less than 4 years. As you can see in 2010-11, they had quite significant buybacks. Since the IPO, the 57.4% owned subsidiary has returned 925 million Canadian dollars to shareholders via dividends and buybacks from open markets and Genworth. Currently, its market cap is 2.43 billion Canadian dollars with a 5% dividend yield and a 7.78 times price over book. Genworth over the years have collected $1.3 billion from dividends, share buybacks, and net IPO proceeds. Yet, its 57.4% stake is valued at only $1.34 billion, or $2.70 per share. Whether this is undervalued or not, we won't give too much comments on it, but ultimately this is a market valuation, and we think it's really absurd, considering that this majority stake is valued at the same amount as what it has collected over the last 4 years. Australia MI. Genworth entered this market in 1997 by acquiring the government-owned insurer. Number one insurer wrote about $490 million of premiums in 2012. Number two is about 2/3. So this Sydney Morning Herald's article actually stated that both Genworth and QBE holds a combined 75% market share in Australia. This Australia MI is price setter. It's managed to implement 40% price increase in 0809 and another 7% increase in first quarter 2012. New insurance return remains strong. It's remained at about $30+ billion since 2009. One key fact is that the net return premiums in 2012 is up 90% over 2010, even though the new insurance return is up 20% only. Of course, the price increase is one factor, but they have also insured more of the high LTV policies. First quarter loss ratio is 47%, in line with targeted and historical loss experience of 40 to 50%. Financial year 12 is actually not comparable because of Queensland flooding. Delinquencies have been falling since 2011. The 2013 delinquency rate is actually still a very low 0.41%. Okay, so quickly sum up about this Australia MI. The IPO stopped last year because of the one-off losses due to Queensland flooding. It's on track to relaunch the IPO in fourth quarter 2013 or after if IPO activity picks up. Book value currently is $2.3 billion. Genworth MI Canada itself IPO at near to 1 times book value barely after the financial crisis. If we use this metric, Australia MI will be valued at a high 4.49 per share. But if we assume that it will be floated at similar current valuations as publicly traded peer Genworth MI, which previously we noted is 0.78 times book, then this segment is worth $3.61 per share, and this is the value that we'll be using for some of the parts later. Next, international protection. Mostly is European exposure. Italy, France, and Finland collectively makes up 42% of its 2011 sales. But its business model is structured such that the bulk of expenses is actually distributors' commission, which makes up 87% premiums. Loss ratio is another 24%, whereas their investment income makes up 20% premiums. So if you add it up, they're actually still making a profit despite weaknesses in the European economy. Lately, they actually this kind of insurance actually taken a lot of flack because they are mis-sold to borrowers. What this does is that they help borrowers to pay if certain specified circumstances are met. Maybe they are death or disability, unemployment, for example. Even though they've taken a lot of flag, they are not liable nor named in any lawsuits because they cannot be put down for the bank's moral hazards. This business management has indicated there is a position for sale in the next 2 to 3 years. Excess capital has paid $119 million dividend to holding company last year, even though NOI fell to $24 million. Another $135 million dividend was paid in 2011, even though the NOI was only $91 million. More impressively, the regulatory capital ratio went up to 345%, up from 220% 3 years ago, even after these dividend payouts. Book value is $959 million, but we think that conservatively it could be worth 1 times statutory capital. This is because this unit can be wholly contributed to the US life insurance or USMI, and now that they are overcapitalized, they can pay out tangible assets, cash, shares, for example, to the holding company. So in fact, this is a asset swap. This is the last operating segment, US life insurance. The profits are very unpredictable because of a lot of variables like mortality rates. If this quarter more people pass away, they'll be recognizing more losses. Loss reserves, they are constantly tweaking their actuarial assumptions. Another factor is capital management initiatives. For example, in 2012, they securitized their life insurance policies and freed up $345 million capital. But this led to short-term gap losses of about $50+ million. Fixed annuities is essentially a spread business. You take the assets and invest at a higher investment return than what you credit to your policyholders. Risk-based capital ratio, which is a measure of whether life insurers are well capitalized, has increased year after year and reached 450% in first quarter. This is up from 400% of internal goal, and now this makes it capable of paying a dividends to the holding company. Long-term care is slightly more troubled. I'll just start with a quote of Howard Marks, which is the chairman of the distressed debt fund Oaktree Capital. There are no bad assets, just bad pricing. The same applies to insurance. A lot of its competitors, Prudential, MetLife, and Allianz, have exited long-term care in the last 4 years due to inaccurate actual assumptions and low interest rate environment. This leaves Genworth to be the biggest long-term care player with 24% market share of in-force policies. This insurance pays a monthly payout used to offset the cost of hiring a caregiver if the insured cannot perform their daily routine, such as dressing, bathing, and eating. Claims typically have a duration of 3 years on average. So the older generation of policies actually made up 1/3 of in-force policies by premiums. They recorded 104% loss ratio. What this means is that if they take in premiums of $100, they'll pay out $104. This is versus the 51% loss ratio of the newer generations. What they have done is they've implemented many rate increases in 2010 and 2011. Last year, they've seek approvals for another $300 million annual premiums increase when fully implemented. Competitors have either exited or are seeking rates now because it's uneconomical. As of first quarter, $60 to $65 million of targeted increase is approved. This market leadership position, 1 out of 4 policies, will give it extra clouds on the negotiation table. Valuation-wise, we are looking at $11 billion GAAP book value, but $4 billion is due to unrealized gains on fixed income portfolio, as well as gains from interest rate hedges. Life insurance and long-term care needs to match your assets and cash flow to liabilities, so we cannot readily just tell the management to, hey, just sell off, realize all these profits and distribute to the shareholders. For that purpose, we will exclude AOCI from calculations. Residual book value is nearly $7 billion with no recourse debt. Its peers are actually trading between 0.83 to 1.02 times book value less AOCI. If we use the lowest comparable book value, price over book of 0.83 times, and we apply a 20% haircut to reflect uncertainties, this segment will still be worth $9.34. Compare this to Genworth's share price of 10.92 per share. So we are looking at this segment itself is worth almost the entire Genworth. Corporate runoff isn't much because most of debt is consolidated and issued at the holding company level. US life insurance does have some substantial funding obligations, but is securitized by life policies and non-recourse to that segments. Overall leverage ratio is 24.7%. One-off segment currently just earns a spread between interest income and policy benefits. End result is that we have a negative equity of $1.2 billion or 2.38 per share. After you sum up all the segments, what we get is $19.03 per share. Let's say we apply a 20% conglomerate discount. We'll be looking at a fair value of 15.22 per share versus a market price of 10.92 per share. Hence, our calculated upside is 39.4%, and we rate it as a trading buy. Some near-term capitalists, of course, we have a successful IPO of USMI on or after fourth quarter 2013, pending a pickup in IPO activity. We have the sustainable US housing recovery, which after which options will be evaluated for this segment. Regulatory approvals for long-term care will be definitely a positive. And lastly, we have the accelerated sale of international protection segment. So in conclusion, whichever what valuation we look at, we think that 10.57 per share is still trading at a very steep discount. We have a competent management who proactively divest assets. We have strong fundamentals. All the segments apart from USMI are generating profits. We have positive outlook. They are all have excess capital. They are all paying dividends to the holding company. And then the long-term care is actually applying for more premium increases. USMI is a proxy on US housing recovery. Leverage ratio is not too significant. It's 24.7%, and all subsidiaries are well capitalized. So with that, this is what we have for Genworth. So it's time for Q&A. Hi, so we have a question from Thomas. He asked, these are all what's presented is all history. What's the recommendation for future? Okay, so right now the management has actually been actively divesting assets. In fact, they actually have a wealth management segment that they have divested as of last quarter. So they'll be expecting $400 million. I would expect they'll be doing the same for international protection. Looking forward, we think that right now they're actually generating a lot of excess capital. They have paid a dividends before the crisis in 2008. So just paying dividends alone would be a good positive. As well as once they've stabilized all these business segments such as USMI, long-term care, they'll be able to, once they've stabilized all the business segments such as USMI and long-term care, they'll be able to look at returning capital to shareholders via buybacks and dividends, and they have committed to this. Once again, for insurance for insurers, if you are talking about fast-growing ones such as AIA Group listed on Hong Kong Stock Exchange, they'll be valued probably at the profit growth. So AIA, for example, has 2 times book value. They are priced at price over book 2 times. Whereas if you're looking at mature insurance companies such as Genworth, you're looking at the amount of excess capital that they can generate moving forwards. And Genworth itself, what you can see is that they're actually, a lot of the subsidiaries are generating a lot of excess capital, which once they've stabilized their businesses, they can go ahead and return this to capital to the shareholders. Hi, so we have another question. If QE taper, how will the implication of QE impact Genworth? I don't think it will impact much because really, Genworth, a lot of its fixed income portfolio are in long-term debt. So, but of course, if QE tapers, what it means is that the economy is doing well. If economy is doing well, then the US housing recovery will be well underway. Another thing you can look at it is that if QE tapers, the probably interest rates will rise and its AOCI will decrease. But then again, we have excluded AOCI from the calculations of our fair value, so it wouldn't be of much importance. Hi, we have one more question. Is Genworth listed in SGX? No, Genworth is listed on New York Stock Exchange in the US. The code for Genworth on New York Stock Exchange is GNW.
Right. If there are no further questions, we would actually. Oh, okay. There's one more question on the technical outlook for Genworth. If I can't. All right. Let's take the next question first. So the next question essentially is for the US market. After last weekend jobs data, how do we actually foresee the next few weeks? Like what we mentioned in our first slide, essentially we think that the main source of uncertainty in markets right now is really the concerns over tapering of large-scale asset purchases by the Fed. Last week's jobs data was better than expected, right, as compared to consensus estimates, but it was not exactly fantastic, right? So essentially the Fed would want to actually wait for a full third quarter of jobs data to actually make a better assessment, right? So we think that come September, right, FOMC, that would be a good time for the Fed to actually signal through its media conference then to actually on when you actually taper its large-scale asset purchases. Our base case is that you will do so, start tapering end December, right? So we think that looking ahead at next few weeks, essentially major data releases will be seen in the context of concerns over how does it affect the schedule of tapering of large-scale asset purchases. With regard to the technical outlook for Genworth, our analyst has no comments at this juncture. The next question is, in general, are we hoping for good or bad news in order to benefit the global market? I think that at this juncture, it seems that markets are a bit dysfunctional in the sense that bad news for the economy is often greeted with good news in equities, right? So bad news in economy means that you wouldn't have a sooner than expected withdrawal of large-scale asset purchases. So that means that translates to good news for equities, right? Good news for good macro data also would actually lead to a rally in risk assets. So in both ways, you'll continue to lend support to global markets, notwithstanding the recent pullback. Is still a healthy pullback in the upward trend for equities. If there are no further questions, we will end our webinar here at this juncture, and we thank you for spending time with us this morning, and we look forward to seeing you next week at the same time slot. Cheers.